Gold is falling, and at the same time, inflation risk is rising again. Now, on the surface, that doesn't make sense, because typically, when inflation expectations build, gold is one of the first assets to respond. But that's not what we're seeing. And when markets behave like this, it usually means something deeper is shifting beneath the surface. More importantly, if you're watching gold, silver, or the broader system, this kind of move tends to come before a larger repricing. Welcome to Money and Power. Over the past 24 to 48 hours, markets have moved quite sharply. Oil has pushed higher again, reflecting ongoing supply concerns and geopolitical tension. The dollar has strengthened, and equities have come under pressure. And gold, instead of rising with that inflation signal, has pulled back towards the $4,600 to $4,700 range. Silver has also shown signs of weakness, falling back to just above $70 to $73. So what we're seeing is not a simple inflation trade. It's something more complex, because the usual relationships, the ones most people rely on, are no longer lining up in the way people expect. And when those relationships break down, that's usually where the opportunity sits. Now, if you look at this through a traditional lens, it feels contradictory. Higher oil prices typically feed into higher inflation expectations, and higher inflation expectations, in turn, tend to support gold. So when oil rises, gold would normally follow. But instead, gold is falling. And that creates a tension in the market. A tension between what the headlines are telling you and what capital is actually doing underneath. And this is where most investors get caught, focusing on the narrative rather than the mechanism. The key to understanding this isn't inflation alone. It's liquidity. Because when oil rises sharply, it doesn't just signal inflation, it also acts as a drain on the system. Higher energy costs reduce disposable income, increase input costs for businesses, pressure margins, and ultimately tighten financial conditions. At the same time, the stronger dollar adds another layer, because a rising dollar tightens global liquidity, makes borrowing more expensive, and often weighs on commodities in the short term. So what we're seeing here is not just inflation building, it's inflation rising at the same time as liquidity tightens. And that combination changes behavior. Capital becomes more defensive, cash becomes more attractive, and short-term positioning shifts. Now, if you are finding this useful, just take a second, please, to hit like. It really does help the channel. And for those who want the deeper breakdown, including how these shifts tend to develop over the coming weeks, that's exactly what I cover in more detail on the 2% brief on Substack. Links in the description and comment section below. Now, gold is often described as an inflation hedge, but in reality, it's more sensitive to real yields, liquidity conditions, and the strength of the dollar. So right now, the dollar is firm, liquidity expectations are tightening, and markets are becoming more cautious. So even though inflation risk is rising, the immediate reaction is a move towards cash and dollar strength. And that creates short-term pressure on gold. So this isn't a failure of gold. It's a reflection of the environment it's operating in. Now, this is where it becomes more important, because this kind of divergence, when inflation rises and gold falls, doesn't tend to last indefinitely. At some point, markets have to resolve that tension. Either growth slows enough to reduce inflation pressure, or policy begins to respond to tightening conditions. And when that happens, the relationship between inflation and gold tends to reassert itself. So what we may be seeing right now is not a breakdown, but a transition, a shift between phases. And those shifts are where positioning tends to matter most. So the key things to watch from here are quite simple. 1, whether oil continues to push higher. 2, whether the dollar remains firm. And 3, how central banks respond to this combination of slowing growth and rising inflation pressure. Because it's not any single price that matters. It's the interaction between them. That's where the signal sits. Now tomorrow I'll break this down properly in the weekly update, looking at what's driving these moves and what the next signals are likely to be. That will be published at 6 p.m. GMT. And for Inner Circle members, that's the Substack 2% brief, on Sunday I'll go deeper into what this could mean in terms of positioning over the coming weeks. If you want that level of detail, the link to the 2% brief is below. And if you haven't already, please subscribe to the channel, because these shifts don't happen in isolation, and I'll continue to track them as they develop. And take a look at the videos on screen now. They'll give you the broader context behind what's happening here. Thank you for watching. I'll see you again soon.